Our next guest says that investors are increasingly concerned about volatility amid political turmoil. We want to bring in Amy Wu Silverman. She's the head of derivative strategy at RBC Capital Markets. And Amy, concern about political volatility. So far, we haven't seen it.
It's true. The markets have been remarkably sanguine. And one of the questions we continue to get from investors is, one, will this change? And two, how has this looked in the past? And I can just tell you, using headline VIX, which is sub 13 handle right now, we're kind of 10 full volatility points below what is normal and below what we've seen in past cycles. And I think the French election, Becky, is actually an interesting example because you did get a lot of volatility in terms of we got that win from the right, you got what happened with the left, but it kind of canceled each other out in terms of the gridlock you see on top. And that's a little bit what is happening in the market. That's why we kind of call it a paddling duck market.
You think that there's risk associated with that, though? The idea that we are, as you mentioned, too sanguine looking at all of this.
Yeah, I think I'll give you one interesting stat. Yeah. So prior to the presidential election, you had volatility on that November election day actually, starting to bump up a little. After the presidential debate, it actually compressed. So what was the market trying to tell you? I think it was sort of saying, okay, if you get on the Democratic side enough of a volatility that essentially it's going to put Trump ahead, maybe that makes the election more decisive, not less, which is one of the explanations we've seen investors say why you'd see volatility compress. I think it's a little misguided in the sense that a lot can happen. We just know we have a long runway before November elections begins. And you've seen in past cycles that it's just not that clean cut. And that's why I think there's expectation of volatility that isn't quite there yet will start to rise.
Volatility, the VIX has been incredibly low for a long time. Why do you think that is?
There are a couple reasons, a couple conspiracy theories, I would say. The rise of zero-data expiry trading, the massive volatility selling ETFs, the growth you've seen notionally on that, but also just economically, things are better than investors have expected, and that's certainly part of it. But I think the most important thing is we've now gotten to a point where a lot of investors are concerned that the actual implied correlation volatility of the markets are so low that we've almost reached a lower bound. And the issue is when that happens in history, it only has more asymmetric room to go up. And
there's nowhere to go but up in that situation.
Correct. That's the concern that I hear from investors who are focused on risk in these markets.
How do you protect yourself from a situation like that?
I mean, the protection is easy in the sense that because volatility is so low, by definition, protection is low. Yeah. The issue is, you could have said that 4 months ago and would have been true. And what would have happened? You would have burned up your premium. And so there is this cycle of boy or girl who cries wolf. If that happens enough times, people don't want to play musical chairs. And then, that's usually when you get some sort of exogenous shock that people are not prepared for.
It's weird that with the geopolitical situation around the globe, what we've been facing, none of that has managed to really shock markets.
Yeah, look, I was a financial engineer in college, and I can tell you in some ways it's just math, meaning it's just the weights of the market right now are these handful of stocks, right? Because when you look at S&P versus S&P equal weight, they do diverge. You do see a massive divergence in performance, but as long as we continue to benchmark to S&P or Dow and it's being driven by a couple of stocks that are doing incredibly well, you are putting all your eggs in those baskets, and you better hope that those eggs don't crack.
What interests you beyond this, beyond the volatility factor? What else are you following at the moment?
I think, what is interesting to me is the cross-asset application of this. So one thing we have seen is when you get these political events or when you get these geopolitical events, things are happening in the cross-asset markets, meaning you are seeing energy markets move, or you're seeing U.S. dollar move, or you're seeing sovereign credit move. The really interesting thing is none of that has fed back into equities. It hasn't fed back into equities, and it hasn't fed back into equity volatility. And so a big question we hear from our cross-asset investors is, well, is this going to be a catch-up, or is everyone else wrong? Historically, it's not everyone else who's wrong. And so I think as we head into another earnings season where valuations are full, this is the question that are on investors' minds and why I think they continue to ask about the history around it.
People keep saying, oh, it's this handful of stocks that are leading and nobody else has caught up. But maybe it's just those handful of stocks have gotten further and further ahead because of what's happening with artificial intelligence and the money that's being plowed into that.
And that's certainly, look.
It's not like the other stocks are falling. They're just not catching up quite as rapidly.
There's actually this issue it creates, which we've started calling benchmark FOMO, meaning, if that wasn't your initial thesis, it has to be now, because if you're someone who is benchmarking to S&P and you don't have that massive overweight to these stocks, you do have to play the catch up. But the interesting thing is when we sit down face to face with these investors, there is a reluctance about the fact that they have to play this benchmark FOMO. So you see this artifice around it that I think if you get any sort of indication that the fundamentals aren't there, that we're not going to get this secular or exponential growth, I just don't think they're as embedded or all in as, the sentiment would tell you right now.
The other thing, though, people will say is there's so much money on the sidelines. And if you've been sitting out waiting and waiting, you keep missing that. And maybe the FOMO keeps building from that, wherever you want to find it.
So one thing we do with options is we kind of look at how much positioning has already happened. And I can tell you that was true at the beginning of this year. That started to peak in March in terms of that call demand and that put demand. That isn't really true now, meaning the people who wanted to get long, you would see that in the outweighing of call options. And that essentially has happened, but we haven't seen it incrementally happen from here.
So the risk is to the downside, you think?
Correct.